Hello, everyone. Calling all investors. We are here again Tuesday live with Caeli. We meet every Tuesday, as often as possible, at least, starting at 4:30 p.m. Eastern, 1:30 p.m. Pacific. And we're going to talk about all kinds of real estate, investor stuff, second homes, primary homes even. We'll probably talk about pumpkins because it's getting close to Halloween. But our most important topics today that we're going to cover, first of all, if you ever have any mortgage needs, questions, education, you can always reach out to Ridge Lending Group and even schedule something directly with Caeli if that's in the cards. And you can call 855-74-RIDGE, or you can send an email to info@ridgelendinggroup.com. And with that, Caeli, we're going to talk about three things today. Hopefully you're ready.
I'm ready.
Okay, so the first thing we're going to talk about is current market news, and I'm going to read to you some updates that just happened today. We're going to bring that on screen. Next thing we're going to talk about is physical property reviews. Are clients or are investors actually doing them? And the third topic, and I'll kind of cue you for these as we go. Third topic is waiting versus not waiting in terms of real estate investment. Sound good?
Yes. I'm ready to rock. It looks like we've got a nice intimate group. Hi, and it looks like all ladies. My ladies in the house.
It is
You're outnumbered, Larry.
I grew up in a house like that, and I have nothing but female household members and animals running around. So
perfect. You feel at home. Okay, good.
So market news, Caeli. Did you hear what happened?
I didn't, Larry. What happened?
Well, so craziness happened. And please let me know if you're seeing.
I can see.
You see here, right? So
are you going to tell everybody about muting and unmuting real quick?
Yeah, why not? So last week we had, for those that had the benefit of last week's wonderful Zoom bomb event, where we had some unexpected language infiltrating our account. So there's a couple of reasons for this. The first reason is our link is public, right? And so that's the way we like to keep it. And I actually got yelled at by the Zoom monitors out there because it is public. But we don't require you to register and pre-register and then get pre-approved for the meeting every time, blah, blah, blah. So what's going to happen here moving forward is you're not going to be able to unmute yourself. Sorry about that. The good news is you can use chat in Zoom, and you can also use the emoticons to like raise your hand kind of a thing. If you have any questions, go ahead and use your Zoom. If you're not using Zoom and you're on video and you just have a question, just start waving rapidly, like and just try to get one of our attention, and we'll kind of flag you down. So how's that, Caeli? How'd I do?
Perfect.
Awesome. So here's on screen, for those of you that are aware, every Monday or Tuesday, if there's a Monday holiday, I'll do a week in review market update, and it comes from the wonderful folks at MBS Highway. This dude, Barry Habib, has been doing this thing for as long as I can remember, so at least 25 years. And he built this nice, beautiful interface, and it allows the sharing of information as it comes out. And so earlier today, the Case-Shiller Home Price Index was announced. And what that does is it tracks the changes in the values of residential real estate across the US. And the month of August numbers came out. So nationally, the big US Census Division reported a 13% annual gain month over month, as compared to 15.6% in July. I'm sorry, year over year rather. So August was 13% year over year. July was 15.6. So do the math. It's a 2.6% reduction from July to August. And then on top of that, we heard from the FHFA, and Caeli, you've talked about this website a lot, to go to the FHFA website to look at the house price index, right?
Mm-hmm.
And so what happened was the measurement came out, and again, these are homes with conforming loan limits specifically. And so the house price index decreased by 0.7% in August, which was below the expectation of 0.3% loss. And then 2% year over year to drop from 13.9 to 11.9. So that was at 9/16. And then further on, stocks came out and they were a little bit mixed. And then all of a sudden the market popped. And so like I talk about in the weekly updates with this green 66, what that means is that the mortgage-backed securities have improved. The pricing has improved by 66 basis points, which is this little green guy right here, over the open. And so, you know, we'll see what happens over the next couple of days and how this trend line goes. But we've got more market news coming out this week. And so this is going to be really important to watch, Caeli. Do you pay attention to this much? And how do you
I do.
group?
I do. And guys, you know, I know that this is ultra technical stuff and we're not expecting you to really know exactly what you're looking at on the screen. But the reason that we're bringing this to your attention is that, you know, the markets can turn rapidly without asking us first, our permission first about what we think, based on a variety of variables that we couldn't possibly predict for. They can turn rapidly, and being prepared for what that might mean, whether they go up or they go down, is fairly irrelevant, but being prepared to take advantage or pull the trigger on something at a moment's notice, I think, is the overarching message here. I also want to bring up the fact that even though what you're looking at here looks like a positive thing, a 66% basis point improvement for the day does not translate to an interest rate that was posting at 7.5% yesterday is now at 6.9% today. That is not what this means. It just means that mortgage-backed securities are trading on a positive note. And by the time it actually trails down into what rates we're going to be locking in from a non-owner occupied perspective, and talk about complicated detail, it could be days or weeks or not at all. Okay, so I think really what we're trying to focus on here is that, you know, based on reports, based on the employment report this week, that's going to come up. What is it, Friday, Larry? That's going to probably, depending on what it says, is going to create another blip in the market. But for right now, what Larry is illustrating and why we're seeing some improvement this week is because the Feds, it appears as if they didn't expect the reduction of home values as sharply or as quickly as we've seen them, right? They thought they would taper a little bit slower. So based on the statistics that we're getting, the feedback that we're getting here, they're going to be trading better because they overestimated how the housing market was going to respond to the Fed's hike in interest rates. Now, whether or not, so Larry and I were talking before we got in here with you guys, and, you know, there's speculation. And please, speculation is just that. It's speculation. It's as good as you know, a guarantee on a box of empty air that you're trying to sell an Eskimo. Whatever, that doesn't even make sense. But whatever we are talking about today could have zero impact later. It might have all the impact in the world. But the consensus or some of speculation based on today, they're saying that the Feds may not raise again in November. What is it? The 2nd, I think, is their meeting again, right?
Just
so a week ago, I would have told somebody that asked me, are the Feds raising the rate again November 2nd? I'd say 100%. Okay, I wouldn't have said 100% because I never give 100%, but I would have said 99% they're raising the rate again. And they may well do that. But now, based on this new information, a lot of people are on the sidelines saying, no, maybe they won't. If they don't, then we're going to stay at the level that we've been at, right? We'll stay roughly in this range. So even these improvements and changes you're seeing on your screen right now are not likely to change or move the needle drastically, maybe more than 1/8 of a point, 1/4 of a point max on the actual rate that you're going to be getting or you're going to be locking at.
Does anyone have any questions? Again, it's like more, you know, this is an opportunity. We really don't talk about this live just because it can be very distracting and confusing if you don't look at this a lot. But does anyone have any questions about how mortgage-backed securities affect rates or programs, or just generally speaking, you know, some of the things that we see happening? If you have any questions, again, you can't take yourself off mute, so throw them in chat or raise your hand wildly, and we'll kind of see if we can spot your thing there. So looks like no questions from the group for right now. If somebody
be
does
prepared.
Oh, no.
Right, Larry, that's what we want to, that's the message that we want you to keep here is being prepared, right? Making sure, yeah.
Yeah, I was going to say, it's one of the things that we notice a lot is in all the folks that we talk to, Caeli, and all the dedicated lending specialists, some folks are like, well, you know what, rates are higher. I literally talked to a gentleman over the weekend who was doing a non-recourse. He was doing an entity-based loan, and I think the rate that we came up with him was 10.5%. And he was like, whoa. And I'm like, dude, I just talked to a borrower and he didn't have tax returns. Like he hadn't filed his returns in 2 years. And he was like, well, oh my God, that's really high. And I said, well, what if you were a borrower who had a W-2 job and he was buying a second home and didn't realize it was going to be something like 7.375 with 4 points, because second home gets hit by the FHFA for
Yeah.
the LT. He was doing 90% LTV. So it's all in, I try to bring it up and say, listen, if you think rates are out of your range, Shayla, you've talked about this before. It's not about the interest rate, right? It's about the opportunity.
If you're not doing the math, regardless of the interest rate, you're doing yourself and your investment future a disservice, right? We need to be doing the math, and the rate is wholly irrelevant based on that particular investment's return and numbers. It might be very relevant if it doesn't support and you've got a massive negative, then agreed. That's not the way you want to go after attaching to that property. Maybe as a workaround, you want to look to the seller, right? If you're working with a turnkey, there's nothing you're gonna be able to do with it. You got to move on. But maybe you're working directly with a seller, for sale by owner kind of thing, and you, instead of getting traditional institutional financing, you come up with a land sales contract. You get seller financing for a period of time until rates come back down, and then you refinance and make them whole. And right, there's lots and lots of different ways to skin the cat. My point is, for anybody that's still getting, and I think that these regulars that are on with us today, I don't think any of these people on this call get hung up on interest rates, but it's such a common thing that we have to continue to have the conversation so that we're bringing you guys the formulas that say, yes, rate is important here. No, it isn't important here. Missing out on the opportunity is far more devastating than an 8% interest rate, right? It's all about making sure that you're looking at the investment in real time and what it's going to yield you based on what you have to deal with today. And if it doesn't work, what are the workarounds? What do we plan B, plan C? How are we going to pivot if we want this investment in our portfolio?
Shayla, I've got a question from Michelle, and again, for those of the group, Shayla and I we banter back and forth because we both started lending. When we were in our diapers, and that was a long time ago. So recommendation: what are you going to do, Shayla? Are you going to lock, or are you going to float in today's market rate? What are you going to do?
Lock
all day long, right?
Lock all day long. So I'll tell you, this is kind of the feedback that I give. Obviously that's a question I get every single day. Every single day, do I lock in? Do I float? In my personal experience, I'm going to take you back. Some of you have heard this story maybe. So this is back when I first started acquiring. I was very aggressive in my acquisition, and I was in the industry, right? So I had access to information that maybe most individuals don't. I was watching the ticker tape. I was constantly looking at publications. I was really chasing after interest rates and trying to float the market so that I was locking in on a day that was most advantageous to my return, right? I very, very quickly realized how much time I was investing in that. And the analogy that I came up with later is I was tripping over dollars to pick up nickels. And more often than not, even with all the information I had access to, it was Vegas odds, man. I would be hedging and floating to try and get that best interest rate. And I have more access than others, and I'd play it wrong. And I'd end up locking at a higher rate than I could have gotten a week before, a day before, a month before. Now, am I saying that there is no benefit in trying to make a smart, measured move on when to lock? Absolutely not. But I will tell you, vastly more often than not, holding the lock and floating the lock, trying to play the market yourself is not going to yield the result that you want, especially, and this is the key, especially dependent on the loan size. Okay, does the means justify the end? So if you're talking about a $500,000 mortgage, it makes more sense to put more energy and more time into an eighth or a quarter of a percentage point. We're rarely going to find ourselves in a situation where we're going to have massive differences between what I could lock at yesterday and what I can lock at tomorrow, right? Very unlikely that within the time frame we have to close this loan, that we're going to see some massive spread between what we locked at and what we could have gotten, or what we locked at and what it ended up being, right? Very unlikely. Usually we're talking about an eighth, maybe a quarter, maybe 3/8 of a percentage point. Okay, on the high end, maybe 3/8 of a percentage point, or 0.375. So if you take that and you hedge that against a $150,000 mortgage, the payment difference is probably $20 a month, $22 a month. Is that mentality, is it worth the risk? Is $20 a month worth the risk that you're going to end up with a higher interest rate than what you could lock today? I think no. The means does not justify the end. Now, if anybody disagrees with me, this is an open forum. I want to talk about it. I want to hear what your experiences were for, whatever that perspective was, and have an open communication so that we can all use it and learn from it if it's applicable, et cetera. But more often than not, that's my advice. Lock the interest rate, depending on the loan size, like I said, is going to be to your advantage than floating, because you'll almost over 50% of the time end up with a higher rate than what you would have gotten today.
I swear to God, Caeli, you and I were like reading the same script.
Really?
Yeah, like literally, yeah. Like,
well, we've been doing this for a long time.
It's the same stuff. So we had a couple good questions come in, and Gloria asked the question, but I want to answer Paul's question first. And so Paul asked a great question. It's like, hey, if you have a HELOC and the HELOC offers a chance to lock in a portion of the balance while keeping the rest of your line floating, would you? And I actually just went through this, but I'm curious to see what you'd say, Caeli.
Is the index prime?
It is
Paul,
prime.
do you know it's prime? So the first thing I would do, if we're going to try and really get granular on this and try to micromanage it the best that we can, I'm going to go back and I'm going to look at a 25 year or 10-year or 15-year, whatever, at least a 10-year history of what prime is. If I can go back to the 70s and 80s, I'm probably going to go back that far. And I want to look at the historical average of what prime is. And based on that number, it's really going to probably dictate how I'm going to proceed, if I'm going to lock in a portion or if I'm going to continue to let it float. Because I'll tell you guys, how many of us on this call have seen interest rates rise as quickly as they have since January of this year to October 25th? And as long as you've been doing real estate, or as long as you've seen and watched this stuff, how many have seen them increase this violently? I haven't. It's a first for me. So what does that tell us? There's very specific parameters and details that are creating this environment. We know what it is. It's inflation, right? The Feds have been very clear about their messaging. They're going to stamp it out at all costs. Once they do, what's going to happen to interest rates? They're coming back down. So Paul, my instinct, and I don't have all the facts, I want more information, but my instinct is to say, no, I don't think that you should lock it in. I think you should let it ride, if based on the variables, okay, I do need more information, that in the next 12 months, it's going to be down and you're not stuck, because once you do it, you're done. Unless you know you're going to refinance out of it to a lower rate later, okay, then you got to figure out the cost of doing that and what you're gaining versus what you're giving up. But my instincts say let it ride. Rates are going to come back down, and if you lock it in now at whatever rate they're proposing, I think it would probably be to your disadvantage. If you want to run the actual scenario and what they're offering and some of the other variables, Paul, hit me up off this call and we can look at it together.
Awesome. Thank you, Caeli. So going back to the question from Gloria, you said this a couple of times where you said be prepared. How is being prepared? Do you mean get pre-qualified, or do you mean something different?
I was talking about being pre-qualified. If you're going to be using leverage for any of your acquisition, be prepared. Have your file up to date. If you don't have an application in with your lender, aka Ridge Lending, then get an application in. Go through the problem. Go through the process of your vials of blood and all that stuff. Get it ready, so that if you need, or there is something that comes up, you're not scrambling at the last minute to try and get pre-qualified. And maybe there's an issue. Maybe within going through that process, you found that there is an erroneous thing on your credit report that you didn't know was there. that now we have to take 2 weeks to clean up before you can get qualified, or whatever it may be. Those are real life things. I see them all the time. So I meant be pre-qualified, but I think it applies to anything related to this. Be prepared for opportunities in the marketplace, right? All of you should be looking at the markets of your choice and watching as the prices change. Who has not seen in their markets that they're interested in values or price points come down? Who's not seen that yet? If you haven't seen it, you're going to. Anybody not seen values come down, even modestly?
Looks like you're the only one, Caeli.
Okay. Somebody just said, how good is the pre-approval for? I think that's a great question. I saw that come up.
Yeah.
It's a good question. And the answer, as odd as it may sound, especially coming from a lender, is indefinitely. Let me explain. Okay. Larry doesn't like that answer. The answer is,
I didn't say that.
Okay, I saw a face.
I was
the answer is
prepared to take a sip of tea.
Okay. The answer is indefinitely. All right. So long as nothing negative changes about your income, your monthly liabilities, or your assets, or nothing substantially negative. Now, if let's say you added a $200 a month liability, but prior to doing that, your debt to income ratio was very, very low. Who cares? It's fine. So nothing substantially negative has changed to your income, hasn't dropped significantly. Your monthly liability hasn't increased significantly, and your assets applicable for your down payment and reserves haven't changed wildly. As long as those three things haven't changed, it's indefinite. Now, I would say on an annual basis, as tax returns are being filed, if you're self-employed or you have rental properties, you're going to want to get that re-reviewed, because there's probably elements within those dynamic moving things, right? The underwriting worksheets and qualifications for self-employed and Schedule E, you're not going to know that just by looking at it. So that would be something I would say that on an annual basis you want to have checked. And then lastly, the credit report is the one element in that comment about indefinite that needs refreshed every 120 days. So the credit report's valid for 4 months before a new one is required to be repulled. Otherwise, there's really no expiration date on those.
So I'm gonna put bookends around you, Caeli, because I'm gonna try and keep us safe here. So a couple of things I want to ask you, just for the group again, because it's recorded. So the 120 days is from the day the credit pull to the day the loan has to close.
Correct.
So just for everybody's sake, it's not I wait 119 days and then I actually I go get, then I say, hey, Caeli, I'm ready for a loan, right? You want to close by the 120 days.
Yeah. And since we're talking about that, I'm just as a maybe refresher for some people, remember, for something called rapid acquisition, even those borrowers of ours that have very, very high credit scores, if we're in the Fannie Freddie box of underwriting guidelines, credit score requirement changes based on how many finance properties you have. When you get to the 7 through 10 of those 10 golden tickets, there is an absolute hard and fast 720 or greater. Most people don't realize that if they've started with an 800 credit score and they were at property number 2, but they're rapidly acquiring property, that mortgage debt that's being loaded can very quickly reduce credit scores. I've seen 800 credit scores drop below 720 on many occasions because they didn't know what they were looking at. So one of the strategies that we impose for our clients is that within that 120-day window, if we have good communication and we know what our clients are after, what they're doing, right, what their plans are, they just purchased properties 5 and 6, right? We have 2 more that we need to be purchasing in the next couple of months. So what I'm going to do is that it's day 64 of 120 days. These 2 mortgages just closed. I still have 2 more that I need to close in the next 3-4 months. I'm going to repull that credit report right now before that mortgage debt hits and could potentially decrease my score. So I've just bought us a new 120 days. Hopefully I said that in a nice linear fashion, but that would be one of the optimization strategies that we coach and teach our clients related to credit, since we were talking about it.
I think that's great, Caeli. I know everybody's going to take away from that, especially as we try to figure out future investments. I think that brings us right into our next topic, which is waiting versus not waiting. Have you, in the past, you've talked about this. How do you feel about today in the current market conditions?
Anybody that's going to give you a blanket statement about this, I would be very leery of. Nationally, meaning nationally and housing prices. Anybody that does that doesn't know what they're talking about. So I think that every market is going to be very unique. And I think that you need to weigh your options based on those unique characteristics. Generally speaking, waiting ends up costing individuals, investors, more than pulling the trigger. Putting that into perspective, if you guys look at interest rates, and let's just use for round numbers $100,000 in mortgage debt, 1/8 of a percentage point in rate is equivalent to about $7 or $8. Okay. And then take that and look at the difference between $10,000 in price point. So $100,000 to $90,000. The difference in payment is between $12 and $18, I want to say. I think that's my math. I can do it really quick in a second. So how, they're selling newspapers if the sky is falling, right? Are they going to sell a lot of newspapers if it's all butterflies and rainbows? Probably not. For whatever reason, as a human, as our species, we gravitate toward the negative and we tend to lock on to that. And that fear is very motivating. So do I think values are going to continue to go down? 100% I do. And in, I would say, most markets. By how much, I'm hesitant to give any real strong opinion. 8%, 10%, 13%. Maybe there are going to be markets in which we'll see a 20% reduction in home values. I think that's absolutely feasible and possible. Now, if that's the market that I want to be purchasing in, do I want to buy now or do I want to buy next year when it's 20% less than it is now? Probably, potentially. However, where are interest rates going to be between now and next year when I buy? Right? This is the dichotomy that we have to try and sort out. And you have to make assumptive, or I guess educated guesses that, like interest rates, it's going to be Vegas odds, you guys. If you're going to try and bet that interest rates are going to be this much higher next year, this much lower next year, it's a 50-50. If you think they're going to be higher, 50% chance maybe they're going to be lower, and vice versa. So what's the cost of waiting? What's the real cost of waiting? If we were to attach a tangible number to that, I don't know that I can answer that. But what I would say is more often than not, waiting is going to be to your disadvantage. But be smart about making those decisions, right? What market are you going to be investing in? And do your research. Be informed and make a measured decision versus just an emotional one.
Sorry about that. So Paul has asked a great question, Caeli. So basically what he's hearing is, as long as the numbers work and you're getting the return you're looking for, you should move forward.
Did I not say that? Paul, thank you. Paul, you should be hosting this week's event. Yeah, if the numbers work today, if you are profitable to X degree, don't wait. Absolutely not. If that means that in a year from now, you're more profitable by $50 a month, so what? You're going to appreciate your rents by X amount. And I just do not think that the cost of waiting is going to be to your advantage over what might be. It's not going to be buying Amazon at its opening and right. That's not what we're talking about. Those are not the numbers that we're talking about. So I would say, more often than not, don't wait. But having a one-on-one conversation, you guys, if anybody wants that, and we can look together, right? Try and get predictive appreciation or depreciation values. I think rates are going to continue to go up. Personally, yeah. Maybe I'm dancing around the topic because I don't want to commit, but more often than not, I'm going to say don't wait.
I think if you were pressed, whether I asked you today or I asked you 5 years ago or 10 or even 20 years ago, I expect that you would always have the same answer. If the deal makes sense and you really want to invest, why would you not do the deal? What are you waiting for? Like, that's the part that always got me, Caeli. I don't know, my experience is always, if a borrower in a refinance is tangible, right? Everybody can really understand a refinance. And if the idea of the refinance is you're getting the money that you're looking for, and you can afford the payment that the new loan is going to be, and you want the money, why are you waiting?
Agreed.
It's really the thing that I come up with. So listen, that brings us to the very next topic, and it's our last topic. And again, I want to really stress this is an open conversation. Again, for those, if you're trying to unmute yourself, you can't. If you want to unmute yourself, just let me know, give me a sign, send up a smoke signal, and I'll unmute you from the host privileges here. But the last one is you've decided to not wait, Caeli, and you're going to invest in a property. Should you physically go look at the property, or have somebody that you trust physically go look at the property?
I don't think that that's, well, I don't think, and this is for me, I'm maybe a more seasoned investor. When I first started, I actually would travel to boots on the ground. I'd walk the property, etc. I've been doing this long enough now. So I encourage those of you that are new to this, sure, do it. Once you've established your relationships, I don't think that you personally have to be the one to go and tour the property. That said, and Larry's gonna go ahead and get to this, if you don't have trustworthy eyes on your property, taking a video that can be time-stamped real time, you're actually seeing, you're not just sight unseen and just trusting that somebody else is doing you right, that you may not have some long-lasting relationship with, you're doing it wrong. This is timely because this has come up probably the last month and a half, 3 different times. Where, right, because we're the lender, we obviously get the appraisals, and our clients are shocked at what they're finding as a result of these appraisals. Larry, do you want to interject some of the things that we're seeing?
It's really it's sad. It's honestly sad because our clients who trust us to get them through, and you go through all these hurdles, and sometimes the appraisal, typically when there's a problem with the property, the appraisal is one of the last things to happen. And when there's a surprise that house has mold in it, or it has no doors that actually close to the outside, or it has broken windows, we can't close the loan. And there's very few remedies other than getting that fixed. And if the seller's like, listen, you had your chance to inspect, it's written in the contract, and you decided to now, 3 days before closing, tell me there's a problem with the property, thanks for your deposit, have a nice day.
Oops.
So yeah, it's I am a very sensitive investor, and regardless of where it is, I'm not as comfortable as Caeli. I'm going to either have myself or somebody that I have a very strong relationship with go around and take videos of the properties, and just try to figure it out before it gets even to the lender, like before Ridge even gets involved, right, Caeli?
No, I absolutely agree. I'm personally not going to do it, but I think a video of the property from whomever you're working with, your agent or your turnkey, whatever, I think a video of the property is appropriate. Maybe if anybody wants to put this in chat, how many people are getting inspections? It's not required, right? The appraisal can check off a few of those boxes, but so it's not required for the loan, but how many people are getting inspections up front in your contingency period? Yeah, good, Gloria. Yep, there you go, Lisa. Yep, Jocelyn. Is there anybody on this call that's not getting inspections? Let's talk about inspections. Lynn, yes. Okay, it looks like it's probably, if I had to guess, it's probably unanimous. But for anybody that isn't comfortable doing so, answering, I mean, you should be getting inspections. $200, $300, whatever it is. A couple things I'm going to tell you though about the inspection. Despite how well I know the turnkey or the seller, whomever I'm working with, I want my own inspector. I'm not going to use theirs, even if they have a list of 2 or 3 people. I'm usually going to insist that I am the one selecting the inspector. Call me paranoid, I don't know. It's just been a rule of mine, and maybe maybe it's not necessary, but I want to choose my inspector. The other thing I want to share with you guys about inspections, please keep in mind that the inspector's job, the whole reason that you're paying them is to find things wrong with the property. So don't do yourself a favor. If you're getting the inspection, okay, don't talk yourself out of the investment or the seller to say, forget you, go take a hike. So within that inspection, what you're looking for are deal breakers, right? Big ticket items, foundation, you're looking at roof issues, electrical, plumbing, those are going to be big deals. Mold is a big deal. Asbestos, you don't find that too often anymore, but you're looking for things that can be devastating to your investment and your return. Ticky-tack stuff, you can certainly ask for it to be repaired, but it shouldn't be a do or die, right? If there's a outlet covering that's missing, fine, ask for it to be repaired. But sometimes I'll see investors look at these reports that are pages long and think, oh my God, this thing is got all kinds of problems, when in reality, 95% of the report is it's benign, right? And if the seller will not cure those or fix those, I don't know that I would say that it's worth losing the investment or the property altogether. Anybody have any stories about inspections that they want to share with the group here today? Anything?
If you
Lisa.
do, throw a chat. Oh, Lisa?
Lisa's got one.
Yeah, I'll get Lisa. Ask to unmute. I think I did that, Lisa. Are you good?
Yeah, I did not get a sewer inspection and it cost me $6,000. So
God. Wait, was it a septic system or was it public?
it's the sewer line from the house to the street that was all messed up because of tree roots and what have you. And I didn't get a sewer inspection. And if I had, I feel like I might have caught that, but I don't know that a sewer inspection is in the common list of boxes that we check when we do inspections. And for a couple of $100, I think it's worth it adding that in there, because if sewer things are very costly.
Yeah.
So thank you, Lisa. So
Yeah.
I'll throw one in. The reason why I asked about septic, I'm in New Jersey, and the part of New Jersey where I am, it's farmy. So there's a lot of
Right.
septic. So the house is from pre-1800s, and and they had horses not far from the house. So the whole area smelled like horse shit, right? It smelled bad. Well, so on home inspection, the guy's like, because we had well and septic inspections. So similar to what you found, Lisa.
Right.
But the septic inspection passed, said it was working fine. Turns out it was a converted cesspool. So, and it wasn't a septic. And I only found that out because I walked around the property, or go back my thing about walking around properties. So, so my only feedback is to these inspections. I think you said this earlier, Caeli, is get your own inspection. The one that was given to me happened to be friends with the seller, because it was like the local septic inspector person. So I don't know what happened, but so it was a $25,000 issue.
Oh,
oof. Mine was like 6,000 and change. And
well, I got the seller to pay for it before closing, so I lucked out. But had I not done,
mine didn't come up until like 6 or 8 months later, when all of a sudden there was
oh my gosh,
a sewage disaster in the front yard, and it turns out the tree roots were like
just completely devastated the line.
And had to redo the pipe from the house to the street, and because of the length of the pipe, because of where the house was placed on the property, and it was
slope.
Anyway,
Yeah,
it's worth an extra couple $100 at the front end was all I wanted to. And I don't feel like people have like sewer as in the list of inspections that they normally do, that's not always a standard one. And
I don't think it is. You're right. Yeah, I don't think it is.
Thank you.
Larry, we should add this to, thank you very much, Lisa. We should add this to event content and like just focus on inspections, right? What to look at, what you're looking for.
Yeah. We haven't really done that. And what kind of inspections, and like you said, what does a report look like? How do you interpret it? And if you haven't seen a home inspection report that didn't have ticky-tack things, then you didn't get a home inspection report. Every single one of those reports has stuff that's like, oh, the outlet cover, or oh, this isn't grounded properly. And you're like, yeah, because it's a 2-prong, there's no ground. Stupid stuff like that. But yeah, I think that's a great takeaway. Thank you, Caeli.
Thank you, Lisa. Lisa had a good telltale story. Anybody else have anything as is property? Michelle's got something.
Yeah, you want to go over that one? I'll read it out loud for everybody. So Michelle put a contract in on as is property. When she read the contract over with the realtor, she noticed there was a section for Michelle to be able to get out of the contract within 10 days during the due diligence period, and another section where you could not get out. The realtor mistakenly checked the I cannot get out, but you unfortunately caught it. Well, hopefully you caught it before you signed it and before the contract was out of attorney review. So is that just that's just a heads up, right, Michelle?
Yeah, it's a story I think she's sharing with us.
Yeah, no, it's a really good one, especially in those realtor prepared contracts. Again, if you're an attorney prepared contract state, then it's kind of covered, but these National Association of Realtor contracts are boilerplate. I don't know, out in Oregon, Caeli, are there any wicked stories about just people not reading what they're signing and having a bad
It
situation?
happens, not just Oregon, it happens all the time, right? Your contingencies are a big one where people don't realize that they're giving up. And I think it was especially true, and I think maybe even a little predatory last year when, you know, the home values, and we're feeling some of this now as a result of everything the last couple of years, we're going up so quickly. You had sellers and agents knowing that you could be under contract for 200,000 a day, and a week later you could probably sell it for 225 or even 250, as gross as that sounds. So they were putting, for unsuspecting buyers, and in some cases I was seeing things like they were putting in, you know, the contingencies, and they had $5,000 of earnest money that was non-refundable, that they were keeping, right? They're going to keep this if they don't meet, something came up, right, that was outside the contingency, or they made the contingency 2 days or something, and the unsuspecting buyer just didn't, they're not investors, they don't know what they're necessarily looking at or looking for, and it could be a problem. So if you're working with just a turnkey, you assume you're going to be safe, great. If you're working on your own and you don't have a real estate agent looking out for your best interests, then you better be reading that dang contract frontwards and backwards and know what you're looking at and what to be looking for to protect yourself. I don't want to lose $5,000 or right. I'm not interested in giving up my earnest money because there's something wrong with this property that I found after the fact, and I didn't know better. That doesn't sound like a good time to me.
Lynn had another great one, which was to make sure all appliances run all the way through their cycles. So she had a situation where a dishwasher hose had a pinhole and ended up causing massive insurance claim when the tenant ran the dishes.
Because what happens? What's worse than water damage? Anybody? Holy cow!
Maybe fire.
I don't know, man. I don't know. I may have to wager on that one. I think water damage. I mean, what do they say? There's no more devastating natural force on the planet than water.
Yeah, water
disaster.
beats all. Water
Yeah.
beats all. All right, so yeah, Lynn would definitely agree. So that's been fun. So we've been talking about 45 minutes. Before we disconnect, again, today's topics were really focused on market and property reviews if you're doing them physically, hopefully. Whether you or somebody else, and then also waiting versus not waiting in this marketplace. If you have any questions at all, feel free to post them now. Otherwise, we'll go ahead and wrap up. Caeli?
I think we're good, guys. Unless you have anything, we're here to answer before we're done. Otherwise, we'll see you same channel, same time next week.
Yep. So if you have any questions again, Paul, we'll go ahead and I'll make sure that we get you and Caeli in touch. We had a question on there from Paul. Caeli, so we'll take care of that. And for everybody else, thank you very much for coming today. And hopefully this wasn't too weird that you couldn't unmute yourself. Appreciate your participating. And as always, if you have any questions at all, pick up the phone. Just call 855-74-RIDGE or email to info@ridgelendinggroup.com and keep the conversation going. Thanks, everybody. Have a great rest of your day.
Bye, guys. See ya.